Picture this: a recent date where Bitcoin surged to an astonishing $126,000, igniting social media frenzies and fueling dreams of further gains. Online gurus proclaimed, "This is it. We're going to $150,000," as retail traders piled in, fueled by extreme FOMO. Then, without warning, a catastrophic event struck. Overnight, Bitcoin plummeted to a mere $12,000, wiping out immense wealth in an instant. Over $19 billion in leveraged positions vanished in a single brutal cascade, leaving 1.64 million traders utterly devastated within hours. So, the crucial question emerges: what fundamental understanding eluded these retail traders, and what did seasoned professionals discern days before this market collapse? The critical insight wasn't found in breaking news, obscure indicators, or exclusive paid online communities. Instead, the truth was openly displayed on every single trading chart, yet most failed to interpret these obvious clues. The key lay in two fundamental aspects: the underlying price structure and the revealing footprints of trading volume. For many, charts appear as chaotic noise, candles randomly moving up and down, contradicting social media narratives while their accounts steadily diminish. If this frustrating experience resonates with you, rest assured, you are not alone in this struggle. Here's a crucial distinction rarely explained clearly. Price merely acts as an advertisement, while volume represents the actual transaction taking place. Price shows market direction. Volume reveals the true capital. Neglecting volume is like judging a restaurant by its sign, never checking for customers inside. This video will unveil how expert traders interpret the market across three interconnected layers of analysis. First, understanding the overall market cycle. Second, identifying the strategic maneuvers of institutional money. And third, confirming genuine market movements through volume. You'll soon see the market's true pulse, uncovering institutional flows and real opportunities. By the video's conclusion, you'll no longer perceive charts as mere random price movements, but as a living pulse, revealing institutional capital flow, hidden traps, and genuine chances. This isn't financial counsel, but rather a guide to understanding the market's inner workings before you engage. Now let's dive in. Many traders commit to a single methodology, convinced it's the sole path to success, fiercely defending their chosen school of thought. Whether it's Wyckoff's accumulation, smart money concepts, or ICT's liquidity emphasis, these distinct groups often clash online, disputing the correct approach. What these dedicated adherents often overlook is that they are all observing the same market mechanisms, just from varying viewpoints. Imagine studying the human body. One expert examines the skeletal structure, another focuses on muscle movement, and a third analyzes blood circulation. Each offers a valid perspective on different systems, yet they are all describing components of the identical organism. Similarly, in trading, Wyckoff's phases reveal the market's framework, like the skeleton providing structure. Smart money concepts unveil tactical maneuvers, akin to muscles dictating movement, while volume analysis confirms genuine activity, representing the market's vital energy. Each method is inherently correct because it illuminates a distinct layer of the same fundamental market reality. Markets do not operate by chance. They follow discernible patterns that recur due to consistent human behavior. Therefore, rather than favoring one approach and discarding others, our strategy involves integrating these powerful tools. We'll navigate the market using three layers. First, deciphering the overall cycle to understand our current position in the narrative. Second, identifying institutional strategies to grasp unfolding setups. And third, employing volume to validate true moves versus deception. This holistic perspective uncovers a single truth. Let's begin by exploring Layer 1, the market cycle. This individual observed the stock market's movements and uncovered a significant truth. Markets don't fluctuate arbitrarily, but progress through distinct, predictable phases. The first phase is accumulation, characterized by a quiet, sideways, and seemingly uneventful market. While most individual traders overlook this period, institutions are secretly acquiring assets, building their positions by absorbing available supply. Next comes the markup phase, where prices surge, attracting a rush of retail traders driven by fear of missing out. Euphoria peaks as bullish news spreads, yet what individual investors miss is that institutions are now selling into this frenzy, having bought earlier. The third phase is distribution, where the market once again moves sideways, but with significant volatility, marked by fake breakouts and bull traps. Retail investors often interpret this as a prelude to further gains, holding or even adding to their positions. Unaware institutions are systematically offloading theirs. Finally, the markdown phase brings a market crash, with prices plummeting, triggering widespread stop losses and liquidations. Trapped and panicking, retail traders face heavy losses, while institutions, having exited, observe from the sidelines. This complete cycle of accumulation, markup, distribution, and markdown then repeats endlessly across all assets and timeframes. Understanding your current position within this cycle provides insight into future market movements, offering a structural understanding. However, this cycle analysis reveals the what, not the how, failing to disclose the specific tactics employed by large players. This brings us to our second layer of analysis, understanding the tactics of smart money. Even if you identify a distribution phase, a key question remains. How do institutions offload massive holdings without instantly tanking the price? They require substantial liquidity, which they generate by strategically setting traps for other market participants. To avoid immediate price collapse, large players require significant liquidity, which they secure by strategically setting market traps. Consider a hedge fund possessing a vast amount of Bitcoin. Simply offloading it instantly would crash the price, resulting in huge losses. Instead, their first move involves gently pushing the price higher, just enough to activate stop orders and entice retail investors believing a breakout is occurring. As retail traders perceive this as a legitimate breakout, they enter the market, placing their own stop-loss orders just below their entry levels. The large institution then sells directly into these incoming buy orders, effectively utilizing retail's demand to offload their assets. After selling a sufficient amount, they allow the price to drop, triggering retail stop losses, causing a cascade of liquidations and potentially enabling them to repurchase at a lower price. This pattern is commonly known as a liquidity grab, bull trap, or stop hunt, representing not an illegal manipulation, but rather the typical operational strategy of major financial players. It's akin to fishing. You don't cast a net blindly, but instead locate fish, use bait, and then reel them in. Similarly, institutions identify clusters of retail stop losses, lure prices into these areas, and profit. To identify these occurrences, observe sharp price wicks extending beyond significant levels, or watch for deceptive breakouts that swiftly reverse direction. However, merely recognizing a potential trap isn't enough. Confirming its effectiveness requires our third layer of analysis: volume. This truth serum distinctly differentiates genuine market movements from artificial ones. Volume reveals the actual amount of capital exchanged at various price points. A price increase on low volume suggests weakness, lacking strong conviction, and likely indicates a trap. Conversely, if price rises alongside high volume, it signifies a substantial influx of money, confirming institutional participation and lending considerable weight to the move. Consider price as the scoreboard and volume as the stadium crowd. If the scoreboard shows a victory but the stands are empty, it raises questions about the game's significance or authenticity. This principle applies equally to markets. A price-breaking resistance might appear bullish, but if volume simultaneously declines, it's a critical warning sign, indicating dwindling buyer participation and a loss of momentum. However, a break above resistance, accompanied by a surge in volume, presents a completely different picture. This signifies genuine demand and institutional conviction. We've discussed the theory. Now let's apply it to a real-world scenario. Consider October 10th, 2025, a pivotal day for Bitcoin. Bitcoin was trading at $126,000, and social media was buzzing with unbridled optimism. Everyone believed the price was about to surge even higher. Yet, a closer look at the trading volume revealed a disturbing trend beneath the surface. For 3 consecutive days, price had been reaching new highs. Crucially, each of these higher peaks was accompanied by a significant drop in trading volume. This meant progressively fewer participants were engaging. With each new high, there was less money flowing in and a noticeable decline in market conviction. This pattern is a classic indicator of distribution. It signaled that major institutional players were quietly offloading their assets, while retail investors continued to buy, though with diminishing strength. True to this warning, the market experienced a sharp downturn on the 4th day, culminating in a significant price crash. Had one been diligently monitoring the volume, this impending drop would have been visible. It wouldn't be a certain prediction, but a strong probability. This awareness, born from understanding volume, provides a crucial edge, not in predicting the future, but in being prepared for potential shifts. Let's integrate all 3 analytical layers, beginning with the market cycle. Bitcoin had enjoyed a strong markup phase since July. Months of upward movement, growing euphoria, and bullish news had everyone anticipating $150,000 by Christmas. However, the Wyckoff cycle indicated we were entering a distribution phase. The trend was clearly mature, with signs of exhaustion becoming increasingly evident. This set the stage for smart money to act. On October 3rd, 5th, and 7th, there were 3 distinct attempts to artificially push the price higher. Each instance served to sweep liquidity. These pushes triggered retail buy orders above previous highs, providing institutions with the perfect opportunity to offload their large holdings. Notice that each breakout attempt quickly failed, spiking briefly before retreating. This was not a sign of bullish strength, but rather clear evidence of ongoing distribution by large players. The third crucial indicator, volume, painted an even more concerning picture, revealing the true nature of these price movements. On October 3rd, Bitcoin reached $123,000 with a $24 billion trading volume. 2 days later, it climbed to $125,000, yet volume dropped to $19 billion. By October 7th, the price touched $126,000, but the trading volume had further decreased to $14 billion. This was a clear divergence. Rising prices, coupled with declining volume, signaled a classic distribution phase, where large players were selling into retail enthusiasm. Soon after, the price began its descent, forming a pattern of successively lower peaks and troughs, confirming the bearish shift. Then, on October 10th, the final trap was sprung. The price briefly surged to $122,000 before a catastrophic collapse. Within just 6 hours, $12,000 was wiped off its value, leading to a staggering $19 billion in liquidations. Many retail investors were devastated. Meanwhile, institutions, having strategically sold for 3 days, calmly watched from the sidelines. This wasn't chance or secret knowledge. It was about diligently reading the market's layers. The first layer warned of a late-stage cycle, urging caution. The second revealed active liquidity grabs and unfolding traps. And the third indicated declining volume, confirming the price movement wasn't genuine. Observing all 3 layers would have kept you safe, perhaps not shorting, but certainly not longing, allowing you to remain prepared on the sidelines. This integrated understanding is the skill we aim to develop. Yet, even with this knowledge, traders still often lose, because knowing isn't enough. Execution is paramount. One common error is neglecting the broader time frame. A seemingly bullish 15-minute chart entry might, on a 4-hour view, reveal you're buying into a major distribution zone. Always align your trades with the larger cycle, not against it. A second mistake is allowing the fear of missing out, FOMO, to override objective data. Even with declining volume and late-cycle warnings, the urge to participate can lead to bad entries. The market, however, only rewards disciplined decisions, not emotional ones. Even when social media is buzzing and your group chat is celebrating, entering a trade out of FOMO, despite declining volume and a late cycle, often leads to holding losing positions. The market rewards discipline, not emotional reactions. The third frequent misstep for traders is making the process unnecessarily complex. They often overload their analysis with too many indicators. This means juggling 15 different indicators, simultaneously monitoring 8 time frames, and cross-referencing numerous divergences and oscillators. Such an overwhelming amount of data invariably leads to analysis paralysis, preventing clear decision-making and decisive action. In contrast, the most effective traders consistently maintain a straightforward approach. They understand that simplicity leads to clarity. Their focus remains sharply on 3 core elements: the market cycle, available liquidity, and transactional volume. That is all they need. Let's now explore how to practically implement this streamlined methodology. Here's a step-by-step guide for analyzing any chart. First, ascertain the current cycle phase. Is the price moving sideways, suggesting accumulation or distribution, or strongly trending up or down, indicating markup or markdown? Next, identify crucial liquidity zones. These are typically obvious support and resistance levels, where a significant number of stop losses are clustered. Institutions frequently target these zones, pushing prices into them to capture liquidity, often creating fake breakouts, wicks, and traps. Step 3 involves scrutinizing volume. Be skeptical if prices reach new highs on decreasing volume, as this often signals a lack of conviction. Conversely, a sharp increase in volume accompanying a break of a key level is a strong indicator of genuine institutional backing and momentum. Finally, wait for perfect alignment. Only enter a trade when all 3 layers, cycle, liquidity, and volume, unambiguously confirm the same direction. If these elements do not converge, simply wait. Patience, in this context, truly constitutes your competitive advantage in the market. This robust framework won't make you rich overnight, but it is highly effective at preventing detrimental trades, because in trading, avoiding losses is a significant form of winning. When a low point is swiftly recovered and volume surges on the bounce, it signals a genuine demand, confirming the trap has cleared. This is your opportune entry moment, when all 3 analytical layers, cycle, liquidity, and volume, unanimously point in the same direction. If these elements do not converge, The wisest course of action is to simply wait. Such patience truly is your competitive edge. This comprehensive framework won't guarantee instant wealth, but it serves as a powerful shield against making detrimental trading decisions. In the volatile world of markets, preventing losses often equates to a significant form of winning. It's crucial to understand that this methodology does not offer a crystal ball. No system can predict the future with certainty. Markets operate on probabilities, not predetermined outcomes, meaning even perfect analysis can sometimes lead to an unfavorable result. When less experienced traders face a loss, they often feel bewildered and attribute it to manipulation or sheer bad luck. However, seasoned professionals, when encountering a loss, understand precisely why it occurred. They entered with a clear rationale, relying on probabilities, and accept that probabilities are not certainties, then calmly move on. Trading success is fundamentally about adhering to a robust process, not fixating on the outcome of every single trade. By consistently following this process, reading the cycle, identifying tactics, and confirming with volume, your success rate will improve significantly over time. Don't pursue unattainable perfection. Instead, strive for unwavering consistency, trusting the process and continuously refining it through learned mistakes. You now possess a framework, not a prophecy, empowering you to interpret market probabilities and act with disciplined precision. If this deep dive into market mechanics resonated with you, consider subscribing to uncover more genuine insights, transforming you into a skilled market reader.